Hi, people. Thank you for stopping by Building Wealth with Rajeev. One of my key missions is to help you and myself become better investors every day. In that spirit, this chat can help you save reading other investing book. The chat gives unique insights into how to choose companies to invest, how possibly you can value them, why capital allocation and investing mental models are important. This chat is with somebody who is extremely knowledgeable in investing in finance, who loves teaching and investing in finance, but wants to remain anonymous. He's known on Twitter as 10K Diver. You can follow him on Twitter. I put the handle below. If you find the chat long, please refer to timestamps and click on something which is more relevant to you. If you find it useful, please share with your friends for broader benefit. Follow the channel and please do share what you think about this chat.
So when I select a company to invest in,
Yeah.
what are the factors I look for
Yeah.
in the company?
Yes. Yeah.
Okay. So I think the most important thing is to understand the business. And when I say understand the business, there are, of course, several pieces to understanding the business. The first piece is sort of the 20,000 foot view. So you have to understand the industry that the business operates in. So simple things like, for example, is the industry an expanding industry or a declining industry? Sometimes it's you may not even be able to answer whether the industry is expanding or declining. So, for example, if you look at air travel, for example, see, before the pandemic, air travel was an expanding industry. Almost every year, people used to travel more than the year before. But now, in a post-pandemic world where Zoom rules everything, and you're sitting in Singapore and I'm in the US, and we are able to have these meetings and so on. So it's not clear whether the industry is going to be expanding or is it going to be contracting, or is it going to be at what rate is it going to expand? These things are not clear. But on the other hand, if you take something like pets, for example, the pet industry, anything to do with pets, healthcare for pets, or dog food, or anything to do with pets has generally been expanding for a long time in various parts of the world. So that's clearly an expanding industry. And if you look at cable TV or something like that, direct linear TV, that has been sort of a declining industry, a slowly declining industry for a long time because of people cutting the cord and things like that. So before understanding the company, it's a good idea to just look at what kind of industry is it operating in. And the other thing to understand is who are the key players in this industry. What is the entire value chain? For example, there's this wonderful company called AMT, and what AMT does is they have a bunch of cell towers, and they operate in this industry where the cellular wireless communication industry, but they don't directly serve consumers. So if you have a mobile phone, you're probably a customer of AT&T or Verizon or one of those players. You're not really a customer of this AMT, but AT&T and Verizon, they will be customers of AMT. Because they will be leasing their putting their equipment on towers owned by AMT and things like that. So it's sort of important to understand who are the suppliers, who are the consumers, where exactly is this company positioned in the value chain. So that's an important thing to understand. The other important thing to understand is what is the competitive position of this particular company in the industry that it is in. So, for example, if you take something like Coca-Cola or Pepsi, so if you look at the carbonated beverages, there's basically Coca-Cola and Pepsi, and not very much else. If you look at just carbonated soda, but then if you're looking at a slightly adjacent space. For example, if you look at a company like Monster Energy, they operate more in the energy drinks area, and there they have a huge amount of competition. Sometimes it seems like everybody has their own energy drink brand. So it's not like Coca-Cola and Pepsi. The competitive position is very, very different. And it's also a good idea to understand how that competitive position is it being strengthened over time, or is it weakening over time? So, for example, just a few years ago, if you looked at the competitive position of companies like Mastercard and Visa, it was very, very strong. Anybody who had any kind of a credit card or even debit card, they would go through one of these two networks. Almost every transaction would go through one of these networks. But then you look at what's happening in India and China right now. A lot of people in China use things like WeChat Pay and all these other platforms, these digital wallets. And in India, you have Paytm, and you have the government stepping in and creating their own payment solution and things like that. So the competitive position of Visa and MasterCard is sort of eroding a little bit. At least in developing countries like India and large markets like China, which are growing at a fast rate, there the competitive position is not as strong as maybe it was projected to be a few years ago. So it's a good idea to understand all these things about the broad industry that the company is operating in, the key players, the value chain, the competitive position, things like that. So these are all specific to sort of the industry that the company is in. Then you have to understand facts about the company itself. So here, the most important thing to understand is the movement of money within the business. So the most important thing is how exactly does cash come into the business? How exactly does cash go out of the business? It's so simple. There are a lot of aspects to this as well. So one important thing to understand is in a lot of companies they have various operating segments. So if you look at Coca-Cola, for example, they have they sell bottled drinks, of course, but they also have a very big syrups business. So they a lot of their money is actually made selling concentrate. And so it is sort of important to understand what the key revenue drivers are in a business. And to take another example, there's this very interesting company called Chemed. And what Chemed does is it has two completely different operating segments. So one operating segment, they operate a bunch of hospice centers all over the US. And the other operating segment is they have this subsidiary called Roto-Rooter, which is basically a plumbing business. So there's a hospice business and a plumbing business, and they're both put together and reported. And so you sort of have to understand these two very different businesses if you're looking to understand this company. So that is very important to understand what the revenue drivers are and what the industry the company is operating in, and how are the revenues distributed across the segments of the company and things like that. The other key thing to understand is, when you have revenues, you also have the other side of the coin, which is costs. So one thing to understand is gross margins. So I like to look at whether the gross margins are steady with time, or whether the gross margins are sort of moving all over the place. So if you take a business like Starbucks, for example, gross margins are fairly steady with time. So for every $100 that Starbucks collects in revenue, It spends roughly $30 on buying coffee beans and things like that, and the gross margin is like something like $70, something like that. And that 70-30, that breakup is more or less holding. It held very steady with time. But on the other hand, if you take a business like there's this company called iRobot, which makes these robot vacuum cleaners, and if you look at their gross margins, it's not as steady. So some years the gross margins are very good, more than 50%. Other years, this year, for example, they say their gross margin is expected to be much lower. So it's not steady. So you sort of have to understand, how exactly how steady gross margins have been over time and how steady they are likely to remain in the future. Then the other thing to understand is how the other costs of the company, how they scale with revenue. So for example, if you take a business like say Microsoft. So Microsoft is the typical example of they spend a lot of money to develop a particular version of Windows, but then once they spend all this money, they pay their developers and so on, and they have Windows and Office and all these products which they develop. The incremental cost of distributing this source and buys a copy of Windows or signs up for Office 365 or one of those things, it takes very little to deliver the product to this incremental customer. So the scaling of costs with revenues is very good. On the other hand, if you have a company like Starbucks or something like that, the scaling is definitely not as good as Microsoft, because as revenues grow, their costs also grow significantly. So if you want to sell, say, 20% more coffee, you may have to employ 20% more baristas over time and things like that, right? So the scaling is not as good as Microsoft. So it's important to understand how various costs, how they scale with revenues. The other important thing to understand is unit economics. So if you take, say, a company like Five Below, what Five Below does is it operates a bunch of stores in the US, and basically anything in the store costs less than $5, or most things in the store cost less than $5. And so they've been opening stores like crazy all over the place. And so with a business like that, it's very important to understand, okay, how much does it cost to open a new store? And once a store is opened, how much does the store make in cash in the first year of operation? And how much does it make in the second year of operation? And so on. So this is called unit economics analysis. So if you have a new store, what are the economics? How much does it cost to open? How much does it cost to maintain? And how much cash does it bring in over time? It's important to understand the unit economics of the business. Then there is cash flow analysis. So you have to understand what the cash flows of the business are over time. So there's an important difference between earnings and cash flows. So just because a company reports $1 of earnings, it does not mean that the company has $1 of cash to distribute to its owners. So you have to distinguish earnings from cash flows. And what are the key things that matter for cash flows? Well, one key metric that's important for cash flows is working capital efficiency. So if a company sells a lot of stuff and revenue is growing at a fast rate, but then all this revenues and profits that are growing, they're all tied up in receivables or something like that, because these guys are being very, very generous to their customers and giving them a long time to pay back pay them back for the products and things like that. So if they are accumulating a lot of receivables and a lot of inventory and things like that, sure, they may have accounting profits, but then those profits are all tied up in merchandise if it is inventory, and those profits are actually being held with their customers if it is receivables. So they can't really distribute any of that cash back to the owners, even though they keep reporting higher and higher revenues and profits. So it's very important to understand if a company reports $1 of earnings, how much of that $1 is actually distributable to owners, shareholders of the company. That's very important to understand. And in this context, Buffett has this measure called owner earnings, which is basically if you have $1 in earnings at the company, and let's say you don't want to grow the business, you don't want to reinvest any money into the business for growing it. But at the same time, of course, you have to incur some maintenance expenses and so on, just to preserve the earning power of the business. So let's say you have $1 in reported earnings, but then you have to spend 10 cents of it just to preserve the earnings. So now you have only 90 cents that you can distribute to owners. So that is called owner earnings. And this concept is very important. So how much cash can the company distribute to its owners every year without hurting its long-term earnings power? So that is something that I like to look at. And the other thing I like to look at is capital allocation within the company. So if a company makes $1 of cash, how exactly does it spend that $1? So does it reinvest the money back into its own operations? And if it reinvests into its own operations, at what rates of return is that reinvestment possible? This goes back to that unit economics that we just discussed. And the other thing that I like to look at is how much of the cash is being returned to shareholders every year. This can be either in the form of dividends or stock repurchases. So how much is being returned as dividends, how much is being returned as stock repurchases, how much is being reinvested back into the company, things like that. And finally, you also, if you want to understand how money moves in and out of the business, one important thing to understand is how is the capital structure of the business. So by that, what I mean is if you look at the balance sheet, if you want to produce $1 in revenues, how much capital do you need to produce $1 in revenues? So capital is how much do you need in fixed assets like plant and machinery and things like that? How much do you need in terms of working capital? How much inventory do you need to keep? How much do you have in receivables? And then that is offset by how much you have in payables and things like that. So how much capital do you need? And secondly, how exactly did the company get this capital? So is that equity or is that debt? So if the company has a lot of debt, then you have to get into more details. For example, you might have to get into, for example, when is the debt due? So if the company has $5 billion of debt, is that debt due all at once 1 year from now, or is that due in small $500 million chunks over the next 10 years or 20 years? So you sort of have to understand what the payment schedule for the debt is and what the interest rate is and things like that. So this is all about understanding the movement of money within the business. Everything from the scaling of the costs, the operating segments, the cash flows, the maintenance capex versus the growth capex, owner earnings, everything that we touched upon, capital allocation. This is all about understanding how money moves in and out of the business. And if we understand all this, if I can understand all of this about a company, to a reasonable, with a reasonable degree of certainty and with a reasonable level of confidence. Only then I will invest in the company. If I don't understand these things, and there are lots of businesses that I don't understand these things, I am not even going to look at investing in the business. So that is the most important thing, to understand the business. The second most important thing is to figure out, just because you can understand something doesn't mean you can predict how it will be in the future. So you may understand the business very well, but you may be completely unable to predict what's going to happen in the future. Those are businesses that I generally don't invest in. So I invest in a business if I can A, understand all these things about the business, and B, if I can predict with a reasonable degree of confidence how, say, the next 10 years of the business are going to look like. Is it going to be, is the business going to be around in 10 years? And if it's going to be around, is it going to be bigger than what it is now? Or is it going to be smaller than what it is now? Things like that. And finally, the most important, one of the most important things is price. So even if I have a great business, which has got wonderful returns on capital, and it's got a very strong moat, and it doesn't have very much competition. It's operating in an industry that's growing. It has all these nice things about it. But if it's very expensive, if the shares are trading very expensively compared to the earnings of the business, I'm not going to buy those shares. So I want to be able to buy shares at a reasonable valuation. And no, I'm not looking for I'm not looking for big bargains, but I am definitely looking to buy good businesses at decent prices. And what exactly is a decent price to pay for the business? Well, I like to have a hurdle of 10 to 15% per year returns. And then, so I ask myself, if I pay this much for this business, over the next 10 years, will I be able to conservatively make a 10 to 15% return? And if I'm able to answer that question with a yes, with a reasonable degree of confidence, then I go ahead and buy shares and so on. And one last thing I want to mention is it's very, very important these days when you're looking at businesses to look at the per share results of the business. So it's not just enough to find a business that's earning good returns on capital and all these other things that we've talked about. They should also be doing all these things very well on a per share basis. And frequently, what happens is you have businesses that are growing and that look very good on every other metric. But the problem is the share count is also growing very fast. And that is usually because of stock-based compensation. The existing shareholders are being diluted. So every year, what happens is the business, the company grants stock options and RSUs to a bunch of executives who work at the company. And because of that, what happens is the share count keeps increasing over time. And if the share count is increasing too quickly, then I generally don't like to invest in those kinds of businesses, because ideally what you want is your per share results should be very good. And if the number of shares is growing very fast, then your per share results will suffer. So broadly speaking, these are the various things that I look for in a company before I'm comfortable investing in it.
Yeah, so I think, Tankit, I was pretty exhaustive. Seems like that you spend a lot of time on a company before investing. So couple of things, I just picked it. And one of the things, let's talk about predictability. You talked about the predictability of the business. Yeah, 10 years,
Right.
whether the business is going to be around or it's not. So does it mean that you rule out that let's go back in the time and look at Amazon or Netflix? Will they be the kind of businesses you would invest in, or you would just leave them? Because the way they've evolved, even the founders didn't know that it will evolve like this.
Yes. So I think there is a key difference between predictability and optionality. So with companies like Amazon and Netflix, um, I think even 10 years ago, so we are in 2021. So in 2011,
Maybe
I
2002, 2003.
oh okay. So in 2002, 2003, I probably wouldn't have invested in Amazon because in Amazon's case, it was this uh, online retailer, and there were so many online retailers. It was very clear that online retail was going to be a big thing. But then it was not clear whether Amazon would be a big player in that in that nascent market or not, or at least it wasn't clear to me. So I probably in 2002 2003 I would have considered Amazon to be an unpredictable business, and so I wouldn't have invested in it.
Yeah, yeah, yeah. And
So
2011.
that shows that you shouldn't take anything I say very seriously in this podcast.
No, that's all right because I think it's everybody has different investing style. But talk about 2011. Why would you consider Amazon in 2011?
Right. In 2011, it was fairly clear that Jeff Bezos is a wonderful capital allocator, and that online retail is here to stay, and that Amazon is going to be one of the major players in online retail. So that much was, at least to me, that much was predictable. But of course, what was completely unpredictable, at least to me, was this whole AWS, for example. So
Hmm.
AWS is an example of optionality. So when you have a great capital allocator like Jeff Bezos running a great company like Amazon, uh, sometimes the business evolves in a direction that very few people expected. And so that is fairly unpredictable. But in the case of Amazon, that was maybe you could have predicted the third party retail and the first party retail and all those things. But try as hard as I would have, if I had built a financial model for Amazon in 2011, I wouldn't have included AWS at all in the financial model. And then here we are in 2021, and AWS is such a major part of the business, and it's clear that it's going to be such a major driver of the business going forward. So I would have valued Amazon mostly as a retail business, and I wouldn't have assigned any value to AWS in 2011. So I would have. So that is an example of optionality that is inherent in the business, that I would have completely missed, because I'm just interested in predicting the future based on what I see right now, and I cannot dream of things that don't exist right now or are in a
Hmm.
very nascent state right now.
Hmm.
But generally, when you have a wonderful capital allocator like Jeff Bezos, you get a business that's got lots of optionality to it, and the whole advertising revenue. So Amazon is they collect a lot of money on advertising today, and that would have also been completely unpredictable to me several years ago. So I would have valued it purely as a retailer, not as an advertiser.
So how to get around this 10K diver? I mean, for example, a lot of people would miss out on the gains, right? It's been one of the best performing stocks, right? Now, how to work around that? So what does optionality become a function of? It becomes a function of the entrepreneur. It becomes a function of the business. I'm just trying to get my head around, you know.
That is a wonderful question. Um, I don't have a very good answer for you. So,
Nobody would have.
so
It just, I think we can just have point of views on this. There will be no answer.
the answer that I have is uh, you, you don't have to um, identify every stock that's going to be a major success in the future. So these things are extremely hard to predict, and uh, 10 years ago, I or very few people would have been able to predict that Amazon is going to be this major player in the cloud space with the AWS. But that's okay. I mean, if you can if you can identify businesses that will give you good returns over time based on whatever is already existing in the business, based on the secular drivers that exist in its industry, and decent capital allocators at the top of the business. That is you over time, if you make diversified bets of this sort, you'll do reasonably well over time, even if you don't um, identify Amazon uh, when it was trading at $3 a share or whatever.
Yeah, I think so. I think there is a bit of leap of faith, I guess, somewhere. You got to think of some intuition. I mean, I keep thinking about it. Where does intuition come in every decision making, right? And how does
Yes,
that
absolutely.
manifest? So anyway, I think that's where we say investing is a bit of art and science both, isn't it? I mean,
I think so. Absolutely.
Yeah. So capital allocation is another thing which got my attention. Capital allocation. Who is the best capital allocator according to you?
Well, from what I know, I'd say, well, I don't know who the best is. I'll give you a few names.
Yeah, sure.
Jeff Bezos is a fantastic capital allocator, as I've said before. Buffett and Munger are wonderful capital allocators at Berkshire. I think Tim Cook is an extraordinary capital allocator at Apple. So if you look at Apple itself is a very good business. So if you have a business that's got pricing power and excellent returns on capital, and it can you have ways to grow the business without spending capital, then the guy in charge of capital allocation at the business generally ends up looking very good, because it's not so much the skill of the capital allocator. It's just that the business is such a great business to be in. So even if a terrible capital allocator is running things, they probably won't be able to do too much damage to the business if they just let the business run. And Tim Cook, he inherited a great business in Apple, a wonderful business from Steve Jobs. But on top of that, he completely changed how capital was being allocated at the business. So, for example, when Steve Jobs was running things, they did not have dividends and share repurchases or anything of that sort. So Apple was making more and more cash every quarter, and all the cash was just accumulating on the balance sheet of Apple. And this cash was not being reinvested. And Apple itself was a very, very capital efficient business, even in those days. And it's become even more efficient today because of the scaling of the business over time. But it was just accumulating a lot of cash, which wasn't really being reinvested. And Tim Cook, he completely changed that. And so I think he's a very, very shrewd capital allocator, and he's done so much for Apple shareholders.
And his way of capital allocation, what was unique about him?
Well, he's obviously a world-class operator. When he was Steve Jobs
how did he allocate capital better? Is it by the buybacks and dividends? Is that the way? Or
Uh, Principally, yes. Of course, he did reinvest uh, back into the business to develop new products and to do R&D and things like that. So for example, Apple has its own M1 chip today. So this whole move from Intel based chips to chips that are designed by Apple in house. That all, or at least the bulk of it, I think, was done under Tim Cook. So obviously, he's reinvesting back into the business, into all these initiatives. But in addition to that, he's reinvesting in a way that where he's making these bets where I think the returns are very good, and the amount of capital that is involved relative to the size of the business is not that much. So you put in a small amount of capital relative to the size of the business. I mean, when Apple, with a business like Apple, everything is in the billions. So when I say small amount of capital, I mean relative to the size of the overall business. And for that small amount of capital, you get extraordinary returns and extraordinary scale. And Tim Cook is backing initiatives that look like this. And in addition to this, he's returning tons of capital back to shareholders in the form of dividends and in the form of buybacks. So, I mean, just looking at the business as an outsider, I can't find any. I can't find one thing to point to and say, okay, this was a mistake in capital allocation that Tim Cook made. I can't really find one thing. So he gets sort of an A plus on everything as far as capital allocation goes.
Okay, I think that's good to hear. I mean, yeah, the stock has done extremely well under his leadership, isn't it? I mean, he could not be an innovator as great an innovator as Steve Jobs was, but I think in terms of being a operation person coming from operation background and being a CEO, I think he's been able to take care of things in a slightly different manner, I guess.
Absolutely. And
Yeah.
if you have the chance to get him on the podcast, you should.
I'm not sure whether, I think it'll probably, a lot of people will be chasing for his time. The one thing 10K diver and I see is valuation. It's a stock valuation, right? It's a very fuzzy concept. It's a very concrete concept in one sense, but on the other sense, it's a very fuzzy concept. I'm not sure whether I'm able to communicate myself. How do you look at valuation and prefer metrics? And there are so many P ratios, DCFs. So just talk about how you value the stocks.
Right. So there is this concept of triangulation. So
Okay.
when you have we have a company, and the job of valuation is to determine, okay, how much do we pay for this company so that we get good returns from this investment over time. And generally, when you have a complicated thing that you want to estimate, it's generally a good idea if you have multiple methods of doing this, and they all arrive at somewhat the same answer. If you come at the problem in several different ways, and they all sort of give you roughly the same answer, then you're generally much more confident that your valuation is not too far off the mark. And so this comes from GPS satellites. So when your iPhone is trying to ping a bunch of GPS satellites and find out where it is, it takes data points not just from one or two satellites, but it tries to take at least 4 or 5 satellites at a minimum, and it uses the information from 5 different satellites to triangulate its position, even though we are all living in 3-dimensional space. So 3 satellites would be enough to find the information, but the iPhone typically contacts say 4 or 5 different satellites, so that it has a higher degree of confidence and lower error in the estimate. So valuation is something like that. So you come at it from multiple different angles, and if you're able to, if they all give you roughly the same answer, then you're reasonably confident in your valuation. So there are a few ways to approach this. One is the DCF, as you mentioned, the discounted cash flow method. So basically, for those who are not familiar with the method, who are listening to your podcast, so you predict the future cash flows of the business, and then you discount them at the return that you want. So if you want a 10% return on your investment, basically what you do is you try to predict the cash flows of the business between now and basically forever from now, and then you discount them all back to the present using a 10% per year discount rate, and that will give you a value for the company, and that is how much you can pay for the company today if you want that 10% return from that investment. Now, the problem with the DCF is that it's very, very, very sensitive to the future cash flows of the business, as well as to the discount rate. So you change the discount rate a little bit, you change a few small things about the assumptions. Instead of assuming that the business will grow at 10%, suppose you assume that the business will grow at 12%. And suppose instead of assuming that the business will grow for 15 years, you assume that the business will grow for, say, 25 years. When you change your assumptions like this, the result of the DCF is it changes completely. The DCF is very, very sensitive to these assumptions. So one way to sort of get around that is to use this technique called the reverse DCF. And what the reverse DCF does is it looks at what the price of the company is today in the market. So if you just want to buy the company today, how much do you have to pay for it? And then the reverse DCF tries to find out, okay, fine. If I assume that today's price is correct, then at what rate should the company be growing at? So if it grows at 10% for the next 10% a year for the next 15 years, then does that justify the market price? If it grows at only 5% for the next 10 years, then how much is the market price overstating things? So the reverse DCF is basically you try to look at the market price, and you try to figure out what assumptions are baked into the market price. So, for example, if you've come to the conclusion that okay, the market price, the market thinks that this is a business that will grow at 10%, but I know for a fact, or I know with a reasonable degree of certainty, that this business is going to be growing at 20%. So then the market is undervaluing the business, right? Because the market is assuming that it will grow at 10%, whereas I am reasonably confident that it's growing at 20%. So that way, I can come to the conclusion that the market is undervaluing the business without knowing precisely what is the correct valuation to assign to the business. So the business may grow at 20%, or it may grow at 15% or 18% or whatever. I'm not really making a very exact prediction on that. But I'm reasonably confident that whatever rate the business grows at, the market is undervaluing the business. So the reverse DCF helps you think about valuation from this perspective, where you don't have to be exactly precise, as long as you have a decent margin of safety. So that is one way to value the business. Then there are other ways. So there is you can try to predict what the earnings of the business will be in the future conservatively. and then you can assign a multiple to that. So you can say, okay, today the company is earning $10 a share, but I think the company will earn $20 a share 10 years from now. So the company will roughly grow at 7% a year for the next 10 years. So it will be earning $20 a share 10 years from now. And I think the market will assign a multiple of 20 to that. So now $20 a share times 20, I think the market will value this business at $400 10 years from now. So what is the company trading at right now? If it's trading at $100 right now, then I think I will quadruple my investment in 10 years. And if I quadruple my investment in 10 years, that's a 15%, roughly 15% rate of return. So you can do something like this, but that involves sort of estimating what the market will be willing to pay for this business 10 years down the line. And that is kind of anybody's guess, really. But if you make reasonable assumptions, if you make conservative assumptions about the future cash flows of the business and the future multiples at which the business will trade at, then you can arrive at a decent price to pay for the business today. And if the market price is less than that price, then you might have a reasonable investment candidate on your hands. So that's one way to value the business. Then, of course, there's this price to book and price to earnings and price to free cash flow and all these different EV to EBITDA. And there's a whole bunch of different ratios that you can look at. Which ratio is the best for a particular business, that really depends on the nature of the business and the capital allocations going on inside the business and things like that. So for different businesses, you can look at a bunch of different ratios and come up with a valuation that way. Then there's also this thing that people love to do called the sum of the parts analysis. So you take a business, the business may have 5 different parts to it. You value each part individually, and then you add up the values, and hopefully you get something close to the value of the business. So that's one way to value businesses. So basically, there's a whole bunch of techniques you can bring to bear. And if they all give you roughly the same answer, or if they all tell you that the business is definitely undervalued, or not definitely, but likely undervalued in the market today, then those different valuations sort of support the same conclusion, and you can maybe look at taking a position, assuming you have a decent margin of safety. So valuation, to your point, is also a bit of both art and science.
So it's basically, I think, looking at the multiple valuation matrices and kind of get a feel of whether the business is worth investing or no. I mean, very difficult to kind of get into a very mathematical sense, going by one formula and deciding on that thing, isn't it?
Right, absolutely. So Charlie Munger calls this physics envy. So people like physicists, they like to have very precise formulas for every little thing. If you have an object, and if you have a projectile, it's projected at a 30-degree angle, then how far down the road will it land? And they have a precise formula to calculate that. Valuing a business, unfortunately, is not like that. And it's generally not a good idea to expect to have precise formulas for the values of businesses. But if you adopt various approaches and you try to triangulate on the value of a business, with some businesses you may get completely different results. So the sum of the parts valuation may tell you that the business is worth $10 billion, but then if you do a DCF with some assumptions, you may get the value of the business as $1 billion. Now that's a 10x difference, and you can't really do anything with that. But for some businesses, you may be able to triangulate to within a reasonable margin of error. And if the market price is much lower than a conservative estimate of the value, then you don't really have to precisely value the business, because you know that even if you could precisely value the business, the value you would get would be significantly higher than the market price today. And if you know that, that you may be able to make an investment decision just based on that, without having a very precise sense of what the business is worth.
Yeah. And what do you think about these, analyst estimates? There is a market consensus. There is a Goldman Sachs coming out with something. There is a, Morgan Stanley coming out with something. What do you think about following those estimates?
Well, I'm sure some of them are right some of the time.
Okay. Yeah. Yeah. I mean, because for an average investor, spending so much of time valuation triangulating, just trying to look for an alternative. What could be the easy alternative for them to because these market consensus numbers are out, right? They're public. And
well, some analysts are very conscientious, and they take a lot of pains. They are very skilled, and they may be able to analyze businesses well and value them well. Other analysts, not so much. So now, instead of valuing a business, you now have to value an analyst. you have to decide who is a good analyst you're going to listen to and who is not a good analyst. And also, analysts have a lot of incentives. So for example, a company, the analyst may be working for a company, an investment bank or something like that. And the investment bank may be doing so much of business with a particular company. So if a company wants to raise debt or raise an equity offering or something like that, they may be working with the investment bank. Now, you have an analyst who's working at this investment bank. Now, the incentive for the analyst may not be to downgrade the stock or something like that, even if the analyst feels that this is not this stock is going to underperform the S&P 500 or something like that. The analyst may not be in a position, or he may not have the right incentive structure to come and say that out, simply because the incentives are not there. I generally don't look at analyst estimates or anything like that. And I think it was Morgan Housel who has this famous line, and he says, when you say a company beats expectations or a company misses expectations, it's not the company missing the analyst estimates. It's actually the analyst estimates missing the company's results.
Yeah, I wonder that time, because there's a beats, there's days, and there's a lot of drama around things, which, if you have a time horizon of 5 to 8 years, I'm not sure how much that does matter. I mean, I'm sure Amazon would have missed, or Netflix would have missed their estimates so many times, but they have been a monster of the stocks and, over a period of time. So I would trust
over long periods of time. One or two quarters don't make or break an investment thesis usually.
Yeah, I think so. So coming to valuation, what are you thinking about the recent valuations in the market? I mean, is the market frothy at the moment? Look at some of the SaaS players. Some of them are not even making any money. I mean, we talked about price to earning, EBITDA, cash flows. What's your view on the earnings?
So we did not talk about price to sales. Or price to
EV or something.
Adjusted EBITDA, where adjusted means you add all costs back to EBITDA. Well, there is no question about it that some stocks have gotten a little ahead of themselves in today's market. But then we have to also remember that interest rates are very, very low today. And so when interest rates are low, investors tend to adjust their return expectations for the future. And so what that means is they tend to use a lower discount rate, and that pushes up valuations. So stock valuations, well, there are still companies that are reasonably valued, but there are definitely, unquestionably, a lot of companies that, at least to me, seem extremely overvalued, given what we know about their business. So, of course, some of those, 20 years down the line, some of those, it may definitely look like a mistake valuing them at such high nosebleed valuations. But some of those will definitely succeed, and they will probably beat all expectations we have today for how they will grow in the future and things like that. So some of them may have hidden sources of optionality that we don't know anything about today. And so they may be valued, they may be at a much higher level 10 years down the line or 20 years down the line than what they are today. But by and large, the market, at least my sense, is that the market is, well, a lot of stocks in the market are overvalued, at least by my estimate today.
You want to talk about a few stocks which you think are grossly overvalued?
No, I don't want to look like a fool 10 years down the line. So I will just say that I think a lot of stocks are overvalued. And then when there is eventually a crash, I will point to this podcast and say, I told you so.
What about Shopify?
What about Shopify? Well, I don't know much about the business, to tell you the truth. So okay. They have a phenomenal mission, which is to basically enable anybody anywhere to start an online business with the minimum of effort. And that alone, I mean, if they come to realize that vision, then sure, I mean, this particular valuation that they have today may be justified. But then the problem is, will they realize that vision in the future? Is it easy to predict what the future cash flows of the business will look like based on what they look today? And there, I am not comfortable making any kind of long-term prediction about what the business will look like. I mean, it may be a wonderful business that shatters all expectations, or we may come to realize that it's a good business, but it does not merit the kind of valuation that it has today, which is very, very high by most historical standards and by most commonly accepted measures. So it probably remains to be seen.
Yeah, and if you have to pick one factor for driving the share price, or one key factor in valuation, will it be what? Earnings? Will it be cash flows? What will it be? Or it will be triangulation again?
So is this specific to Shopify, or is that
or just
this is more
question.
of a general
question?
Okay. So it really depends on your holding period. So if you want to determine if you're going to buy and hold a stock forever, say, then the only thing that matters to you are the dividends you will get from that stock, because you can never sell it. You're going to buy it and hold it forever.
So let's say 10 years, I have a 10 years time frame, because
right.
holding forever probably is a bit of a, 10 years time
Right.
frame.
So I'm just illustrating that that is a corner case. So if you're planning to hold a business forever, then the only thing you should be interested in are the future dividends of the business.
That's true.
And how much you're paying for those today.
Yeah.
If you're planning to hold the business for the next 6 months or something like that, then the majority of your returns will probably be determined by market sentiment and things like that, more than the fundamentals of the business. So over time, if you're going to hold a business for say 10 years, as you said, then there are 2 or 3 key factors that will decide what your returns are going to be. So the first factor is how much the earnings of the business, earnings and cash flows of the business grow over time in those 10 years. And then the second factor is what multiple is the business trading at 10 years down the line versus what is the multiple today. So if you buy a business that's trading at, say, 10 times earnings today, and then 10 years later it's trading at 20 times earnings, then even if the earnings don't grow, you have doubled your stock's value has doubled. So and if the earnings have also doubled in 10 years, then your stock's value has actually quadrupled. So if you're planning to buy and hold an investment for 10 years, multiple expansion or contraction definitely plays a role. Earnings and cash flows, expansion and contraction definitely plays a role. The third thing that plays a role is the number of shares outstanding. So if the business doesn't grow earnings at all, but then it buys back half its stock over the next 10 years, then effectively, even though earnings have not grown, earnings per share have doubled, right? Because the shares have been cut in half. So that definitely plays a role. During these 10 years, the dividends that you get over the course of this 10 years from holding the investment, they also play a role in determining what your returns are from this investment. So broadly speaking, growth in earnings, the effect of share repurchases and dilution on the number of shares outstanding, the change in the multiple over the time horizon, and the dividends that accrue to you over the holding period. These are the 4 factors that will that kind of largely determine your returns over such holding periods.
That's really amazing. That's really fantastic response. Very comprehensive. 2 more questions, and then I think we can call it a day. This, in terms of mental models, for a great investor, what do you think 2 or 3 things one should be thinking of? One should be cognizant of. It's not easy to be invest over a long term, isn't it? 1 year success doesn't define anything. To be in the game for a longer time to succeed, what do you think are 2 or 3 key attributes?
So as Peter Lynch like to say, the most important organ for an investor is not the brain; it's the stomach.
Yeah.
In terms of mental models, it helps to be familiar with a bunch of different mental models drawn from different disciplines. So that's what Charlie Munger calls his lattice work of mental models. And what I would say is, if you want to be a successful investor over the long term, at a minimum, there are a few kinds of mental models that you should be familiar with. The first mental model, or the first set of mental models, has to do with how businesses work, how they make money, earnings, cash flows, the fundamentals of how businesses work and how money flows in and out of businesses. There's a whole set of mental models there. So that is very important to familiarize yourself with. The second set of mental models has to do with psychology. So what are some common biases that we all have, and how those biases affect how we behave in the markets during both good times and bad times? That how does irrational exuberance tend to affect us, and how does pessimism in the markets tend to affect us, and what do we do to guard against those kinds of psychological biases that we have? So there's a whole set of mental models associated with psychology that is important. And the third set of mental models has to do with the basic math of investing. So simple things like tax deferred compounding. So if you have a stock that doubles every year, and you just buy it in year one and then hold it for 50 years, you will get a phenomenal result over these 50 years. But then if you have investments that double every year, but you have to pay, you buy and sell at the end of, so at the start of each year you buy a stock, and then it doubles, and then at the end of the year you sell the stock, and then you keep doing this 50 times. But each time you have to pay a tax, you have to pay capital gains tax. Then the amount of money you'll be left with at the end of 50 years is much, much lower than if you could compound for 50 years and then pay the tax at the end. So there is some very simple math that goes into this. It's the math of tax deferred compounding. So there's a whole bunch of math models and simple mathematical results that give you a lot of insight into how investment related calculations work. So humans are generally very good at linear extrapolation, but almost everything in investing is exponential, not linear. And so we need extra math to be able to sort of convince us of things that don't occur to us intuitively. So it's good to familiarize yourself with a whole bunch of math models for investing related calculations. And this includes DCFs and reverse DCFs. And so basically all the things that we discussed before, that there is a certain amount of math involved in all of them. And it's good to familiarize yourself with that math. So I guess, the fundamentals of business, the fundamentals of the math of investing, the fundamentals of psychology. These are three things. And it doesn't hurt to know accounting as well, because accounting is the language in which business statements are written, and it helps to develop a certain amount of fluency with accounting. So yeah, if you learn these areas, then if you cultivate a whole bunch of mental models associated with these broad areas, then it's very, very likely that you'll have good investment results over time.
That's fantastic. I think that's a lot of work, though.
Yeah. Well, if you don't want to do the work, as Buffett said, you should be happy with investing in a low cost index fund, and then you get whatever the return that gets. If you want to outperform, then
you have to work like an outperformer.
Well, yes, or you have to get incredibly lucky.
Yeah, I think so. And last question. So, in the context of all this, what's your biggest holding, and why?
My biggest holding is Berkshire Hathaway.
Okay.
So I'll give you a few reasons. The first reason is that the business has reasonably stable earnings and cash flows. So if you look at Berkshire, it's this huge conglomerate. They own everything from Dairy Queen to Geico to Nebraska Furniture Mart, and they have a wide array of different businesses. But if you look at their cash flows, their cash flows come from a lot of it comes from insurance-driven operations. So insurance contributes this whole bunch of float to the business, and then that float is invested, and that those investments produce cash flows. So a large part of the business is driven by insurance. Then a large part of the business is driven by is in energy. So they have this this Berkshire Hathaway Energy, which used to be formerly called Mid American Energy, and then they have this railroad, and a lot of their earnings come from these three big sources, and these sources tend to be relatively stable. So the float that is offered, that's provided by the insurance operations, is fairly stable. It doesn't really go down dramatically with time or anything like that. It's been reasonably stable over the years. And energy operations, if you're supplying electricity to a large town or something like that, that tends to be a relatively stable business. And the railroad is sort of tied to the U.S. economy, and as long as the U.S. economy does reasonably well over time, the railroad will probably do fairly well over time. So the cash flows of the business are fairly stable. That is one key reason why Berkshire might be a good investment. It's not the easiest business in the world to understand. But at a very high level, it's possible to look at the business and conclude that it's a relatively stable sort of business. The second big reason to invest in Berkshire has got to do with just Buffett and Munger, and they're Todd and Ted. They are extraordinarily good capital allocators, and so they are able to take capital, say, out of See's Candy, and put it into something like Geico or something like that, or they're able to take capital out of Dairy Queen and then use it to buy shares of Apple, and so they have this wide array of businesses. And they're very good at taking the capital out of one and allocating it into another. And over the years, they have shown themselves to be very, very rational when it comes to capital allocation. So if you look at what kind of stocks Buffett was buying in 1999 and 2000, at the height of the dot-com bubble, he was extremely disciplined, extremely patient, not doing anything which he did not understand. He's very, very rational, and he's sort of able to set himself. He and Munger and Todd and Ted, these guys, they're able to sort of step out and have a clear view about the markets and what is reasonable and what is not reasonable. And that doesn't depend on the level of the market, or there could be total insanity going on in the markets, and these guys will still keep a cool head and allocate capital rationally. That is extremely important, especially for a business that doesn't pay any dividends. You want the capital allocator to do a good job, and these guys are the best at it. That's the second reason: rational capital allocation. The third reason is they are clean. So a lot of businesses you read the 10K and so on, you come away with the impression that you're not really sure whether this is a squeaky clean business or not. Stock-based compensation is generally out of hand. The CEO pay could be very high. So many things like that raise red flags. And Berkshire is a business where they have very few or no red flags. You can be reasonably sure as a shareholder that the people at the top of Berkshire, they have your best interest at heart. And that is something that can be said for very, very few businesses. And I am reasonably sure that Berkshire is a very clean business in that sense. So that's the third reason to invest in Berkshire. And then the fourth and final reason is, Warren Buffett, who understands the business better than any other living soul, is spending $5 billion or $6 billion a quarter buying back shares at these prices. So what more do you need to know about this business? Warren Buffett is buying back shares of this business, and Warren Buffett is the one who understands this business the best. So it is kind of a no-brainer to me, at least, looking at this set of conditions to say that this is likely to be a very good investment over the next 10 or 15 years.
Yeah, I think it's solid. It's really, really solid, and it's like it's like ETF on its own, I guess.
Pretty much, yes.
One thing I just, and the last thing is, over the last 10 to 15 years, I think, the Berkshire performance, I don't think it has been, it's a good performance, but, I'm not sure whether it has been able to beat S&P in last 10 or 15 years. Investors would have been better off investing in S&P index than investing in Berkshire, isn't it? Maybe
I believe over the last 10 years, they may have been better off investing in the S&P over investing in Berkshire. So 10 years ago, sometime in 2011, I believe, Buffett announced that he would buy back shares at 1.1 times book. Mm-hmm. And when he made that first announcement, Berkshire was trading at something like $70 a B share. The B shares mm-hmm. were trading at $70 each. Mm-hmm. And today, the B shares are trading at about $280. Mm-hmm. So that's a quadrupling over 10 years. And quadrupling over 10 years is a roughly 14 to 15% rate of return. So if you had invested in Berkshire in 2011 and held your shares until 2021, you would have got something like a 14%, 15%, depending on the exact price that you bought it at. You'd be sitting on a 14% or something like that. Now the S&P has done may have done slightly better than that. I don't know what the exact figures are for the S&P 500. But 14% is not a bad rate of return.
No, it's pretty handsome.
Very,
it's
very hard
impressive.
to in a long bull run. Mm-hmm. It's very, very hard to beat the S&P 500 over a long bull run. But ideally, the way to compare performance is to do it over a complete cycle. So to take a bull run followed by a bear run, and then compare the performance over this cycle. And so for a long time, we didn't really, we haven't had any kind of prolonged downturn in the markets. Well, there were in 2020 we suffered a downturn, but then that was very quickly corrected. So I am comfortable holding on to Berkshire at these prices, even even though the S&P 500 may have done slightly better than Berkshire. I really think Berkshire is well positioned for any future downturn, and we know that there will be a future downturn. It's just we don't know exactly when. But I'm reasonably comfortable holding on to Berkshire today and through any eventual downturn.
Okay. Other now makes sense. I think, Tankit, I would thank you. I think very enlightening chat, and I learned a lot of new things. So thank you so much. Really appreciate your
Thank you very
time.
much, Rajeev.